Hi everybody, it's Michael Berman here from Signal to Noise, S2N, a global macro research boutique. And I'm going to take you through a short explainer about non-farm payrolls, and you'll be able to watch this in your own time, and hopefully you'll find it useful. So actually, before we even begin, I'm going to go straight to a disclaimer here, and I want to share that this is not financial advice. I'll pause it here for a few seconds so you can read. I'm not going to read the whole thing yet, but I just want to get that disclaimer out the way. Let's just talk now about the non-farm payrolls. So what is non-farm payrolls? So it's a measure of the total number of people employed in the United States, excluding sectors like farming, as it says, non-farm payrolls. It excludes private households and non-profit workers. It's published monthly. It's a very, very popular news release that's very well traded, and it's usually on the first Friday of the month, and it is being released tomorrow. So it gets released at 8:30 New York time, and many, many people around the world trade around this particular time. So is it a good news release to trade around? Well, we're going to have a look. So let me walk you through things systematically, and hopefully you'll be able to follow and gain some extra knowledge that you didn't have beforehand. So if you take the non-farm payroll numbers off Fred, which is the free service that the St. Louis Fed publishes, fantastic resource. But the first thing that is easy to do is get tripped up on this. So you'll see here, this data goes back to 1940, so it's a long time series, but the latest number is 160,000. Well, it's actually not 160,000, it's actually 160 million. So that's the first thing, just be careful. It's easy to mistake that, especially because the last forecast for non-farm payrolls was 160,000. So I'll walk you through what I mean there. So I just want to alert you to that. But anyway, you can work with my charts. I prefer my charts to anyone else's charts. So whatever I got here, I've plotted the same thing. You can see it, but what I've done is I've got the monthly bars, as you can see in green. If it's a positive month, and if it's a negative, it's a negative. So I've also made, as you can see, our non-farm payrolls. It's 159 million, so it's rounded to 160. You can see that. So this is measuring the change of each month. So the change, 256,000 new workers were added to the US payroll system last month. Okay, simple as that. We can look at it in monthly. Just you can see these huge spikes here. What was that? That was the pandemic. So not surprising you saw a massive, I'm just trying to think what it, yeah, 2 million, I think that's the right number. 2 million people lost a job for that particular month. Anyway, we now look at it in percentage terms. So I'll show you over here. Whoops. It went up 0.16% in percentage terms. This is a long data set. Might be hard for you guys to see like the movements of those green lines here. So what I've done is I've actually just shown you a shorter version where I have gone back. I think I went back to 2023. So just to give you kind of a sense of what the monthly numbers look like, these green bars. You can see we haven't had a negative for some time, and in percentage terms you can see it over here. Okay, moving along, let's get into the numbers. So what have I done? I'll share with you something quite interesting. I was able to get I'm sure I can go back further. In fact, I will, but just for the sake of this particular study, I was able to find the actual release dates of the the non-farm payroll dates going back to 2017. There's roughly 120 observations. What I did is I took 1 minute data. This is for the S&P 500, and I then plotted on those. I took 120 observations, so 120 different dates, and I looked at how did the market, the S&P 500, perform 1 minute after 8:30. So I was looking at the futures, obviously the S&P 500 futures. How did it perform 1 minute after the release? How did it perform 10 minutes, 30 minutes, 60 minutes, 4 hours, and 1 day? And this is what you get. So very close to zero after a minute, as you would expect. Here it starts to get slightly negative after 10 minutes, and you can see going on up to 4 hours, it's spot on the number. You can see these whiskers here on this particular plot. What this is showing is how wide the range is of the 120 observations. How, some were up here, some were down there. So it's measuring the variability of those returns, like standard deviation of those returns. And we won't go in. I mean, you can see the further out in time, the wider the variation in results are, which is kind of logical. But we're going to focus on the blue dot is the average, the mean. So on average, the S&P is up after 1 day. So that's very interesting, because I would imagine most people who trade the non-farm payrolls are not holding it for a day. And if you, on the long side, if you hold it, if you buy in it, it turns out that it's more profitable to hold it the entire day, which kind of goes against what I think many people do, is they're in and out. As you can see, S&P 500, very hard to make money unless you've got an angle. Let's look at it for gold. We've got, this is the average for gold now, once again, going 1 minute, 10 minutes, 30 minutes, etc. Over 120 observations. After 4 hours, you tend to be slightly positive, and after a day, it's slightly negative. So opposite to the S&P 500. Let's just look at it. I did one other symbol I looked at the euro dollar. And once again, okay, well, actually the 4 hour here had the most interesting variation, the biggest move. So trading for a really short period of time, you are obviously making it harder to make a profit from the trades, because you can see it's moving very, very little on average. Okay, but you're going to say to me, well, what happens if there's a positive, if the non-farm payrolls came out better than expected and all those kind of things. So what I was able to do was I found a source where I could get the forecast and the actual. It goes back to 2022, March 22, 2022. And what I did is I categorized the release. So if there was a difference of more than 10%, so if it was forecast for 160,000 and it came out 10% better, which would be 176,000, it would be a positive. So yeah, it was 60% better, 13%, so it's positive. And obviously on the downside for negative, if it came out 10% below, 10% or more below the forecast, then it was classified as negative. And then there's that buffer of 10%, up to 10% positive and up to 10% negative. I call that neutral. So as you can see, yes, up 8.4%, so it's considered neutral, and there you got some neutral entries. Okay, so now what I did is I took all this knowledge, these categories, and then I broke up the data. So let's look at it a little bit deeper and see if we can find any more interesting insights. So what have we got here? So there were 13. So let me just go back here. There's only, I think there was 20. Sorry, I thought I'd marked it somewhere here, but there were only 20. There's only 20 um, data points here. It could be 21. I stand to be corrected. So there were 13 that were considered positive releases. So what do we see here? Interesting there. On average, when there's a positive release, we definitely don't see any, on average, shooting above. Look, it's a small sample, there's only 13, so you can't draw too many conclusions, statistically robust conclusions, and I'll obviously try my best to find more and more data to add to the study so we can really get a firm grasp on how the market reacts to these releases. But I found this quite interesting that on average, when it's a positive release, positive surprise, that in fact the market ends the day on average down. And that's probably because the market has a sense of what the release is going to be, and hence trades ahead of it. So probably the market was trading up until the release. What I probably need to do, and I'll do that for the next version of this study, is I'll actually look at data beforehand. I think that would be quite interesting. So now let's look at negative surprises. So there's only two, so you obviously can't draw too much, or if any, but it's still instructive and interesting that of the two observations where they were negative, on average, the market ended higher at the end of the day. Pretty interesting. There is a little bit more variability with negative, but once again, small sample sizes. And the neutral, as you would, I guess, expect that, look, there were only 6 of them, so it would be in line. But yeah, slightly negative for the day. Okay, so now let's look at it in gold. Once again, 13 positive surprises, and this is what we see. It has, there seems to be a trading opportunity around gold, a positive bias. I'm very scared to draw too much conclusion. I would far more, be more comfortable relying on my 120 observations, which I had over here. What did it say for gold? That's 120 observations versus 13 and 6 and 2. So we've got to be a little bit careful with that. Where's gold? Let's see 500. Let's see gold. Yeah, so we were looking at it here. The negative surprise, once again, contrary to what you would have expected, the market rallied. And neutral is in line. And now we look at it we look at the euro. Positive surprises. So clearly, markets seem to want to trade in advance of the news and kind of adjust afterwards. Negative for euro, and here's neutral. Okay, so what I wanted to add one further thing to this analysis, which I thought would be quite interesting. FX Blue, a software vendor, service provider in the FX space, has a very interesting, it's a free service, this. You can check out their non-farm payroll tool. And what they've got here, I'll just show it to you. Let me just refresh it. I'm going to show you what it's able to do. Okay. So what we're going to see is here's a history, and that's where I actually got my data from forecast and actual from, but they only go back to March 2022, so I'll have to look for another source where I can go back further. But they've got the forecast and actual. So let's just take a look at what they do here on January. So on January the 11th, was the last release. You can choose amongst a number of different symbols, and they show an hour before, an hour and an hour after, but you can replay it. So let's click on that button. So that was what the market looked like an hour before, and this is how it traded an hour afterwards. There's also the sentiment here, but we'll ignore that for now. I'm going to focus. Let me make the screen slightly bigger. So that was a replay of that. We can actually go back in time. We can go look at, I'll just take the Aussie dollar as an example. So I'll replay it, and you can kind of watch how it unfolds over the hour. A pretty cool tool by FX Blue, and it's free. So yeah, take a look. I hope you found that useful. Oh, one last thing before I sign off. You know, as a Trade Nation partner, I have this particular tool, which is an MT5 tool for, it's a whole, you know, there's a whole series of features that it has. But if you're a Trade Nation client and you would like this, well, then just be in touch and you'll get, you know, I'll set you up. I'm not going to give a demo on how all these features work, but there's a lot of cool stuff that's available on this particular tool. Okay, we'll leave it there. Thanks and good luck with your trading.